Gold and silver had a good week last week, and so did the mining stocks. But this week was the cherry on top. Gold finally hit a new all-time record high earlier today. We traded, I think, for the first time ever above 3,450. I don't think we quite closed above that level, just below it. But gold had a great week. It was up about 2.5%, over 2.5%. Silver had an even better week. It didn't hit a new all-time record high, but it did hit a new 13-year high. In fact, silver almost traded $40 an ounce. I think it got within about a nickel.
In today's news recap, Morgan Stanley raised its gold price forecast for the fourth quarter to $3,800, favoring gold, silver, and copper futures. Morgan Stanley published a report on the metal industry stating that a further weakening of the U.S. dollar should provide a tailwind for commodities. An increase in U.S. inflation could also attract inflows, and any stimulus policies from China would be an unexpected bullish factor for the industry. However, U.S. tariffs pose growth risks as the effect of stockpiling gradually fades. The bank prefers gold, silver, and COMEX copper futures. The bank expects tariffs on certain countries to be raised again starting August 1st, and tariffs on industries such as steel, aluminum, and copper may also affect and push up cost inflation in the industrial sector. Exports continue to support Chinese metal demand, but this support may weaken as tariff suspensions end. Morgan Stanley believes that the trends in the metal market this year will continue, with upside potential for COMEX copper, gold, and silver, but platinum is expected to stabilize after a roughly 50% rise. The bank has raised its fourth quarter target price for gold to $3,800 per ounce, supported by central bank and investment demand driven by a weaker dollar, ETF bid, and ongoing uncertainty, while jewelry demand may recover as consumers adapt to higher prices. The bank forecasts gold prices $3,800 per ounce in quarter four 2025, marking a multi-year top as the bank expects $3,500 per ounce in quarter one 2025, 2026, and $2,500 per ounce for the full years of 2026, 2027, and 2028, respectively. However, Morgan Stanley also points out that there are many uncertainties in the industry. Key issues include the path of U.S. tariffs on specific countries and metals, the outcome of the U.S. Section 232 investigation into critical minerals, and whether China will introduce more stimulus measures. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps.
Closed around 39.80-ish. I forget exactly. In fact, I don't think they've settled it yet. I'm doing this podcast just after 4, and they're still trading. But it is a new 13-year high. This is a great close for the week and the day. Ahead of a holiday weekend, we've got the Labor Day holiday on Friday. In fact, I would expect a gap up in both gold and silver. I think by Tuesday, when American investors are back looking at the markets, I think that you could see a big gap up, whereas silver opens above $40 an ounce by Tuesday, and gold above $3,500. We'll see. Now, the gold stocks, again, as I mentioned on my podcast 2 weeks ago, continue to lead the way now. They're not being dragged behind like they were reluctantly, with investors completely skeptical of the gold bull and expecting it to die any day. Now, the gold stocks are leading. In fact, as of, I think, this week, gold was down about 2%. During a time period where gold stocks were up 20%. Gold was just consolidating while the gold mining stocks were catching up. That's why I was hammering the table back in April, May of this year about buying the gold stocks, that was the best place to buy gold was in the ground, because these stocks hadn't even moved yet. Well, now they're moving. And in fact, the GDX, which is the larger gold mining stocks, is now up over 87% on the year. This is shaping up to be the best year maybe ever. I mean, I guess if you went back to the 1970s, I don't know if this index, I don't think it existed back then. This is certainly the best year in the history of this ETF, and the year's not even over yet. I mean, I think that gold stocks are going to more than double as a group, which means some stocks obviously do a lot better than that if the average is a double. But right now they're up 87, over 86%, excuse me. It's the GDXJ, the juniors, that's up over 87% so far on the year. So these stocks are making a big move. The year-to-date gain on gold is now 32%. Gold is having a phenomenal year. Silver up 38%. But I think once we get above 40, we're going to make a beeline for 50. And then, as Katie barred the door once we're above 50. So don't wait. I've been hammering everybody on my podcast, on my X feed. I've been telling the guys at Schiff Gold, get on the phone, talk to your clients. They got to buy more gold and silver. And what I've been getting as feedback is that the clients have been reluctant to buy because they're worried about buying the top and they want to wait for a pullback. And I've been saying, don't wait for any pullbacks. You're not going to get any meaningful pullbacks. You just got to buy. Yes, you're buying the highs, but you're going to have to buy the highs or you're not going to buy. And the problem is the highs are going to keep getting higher. And so the longer you wait, the higher the high you're going to buy. So don't wait. In fact, remember when silver first moved above $30 an ounce, I was telling people that 30 is the new floor, that 30 on silver was like 2,000 in gold. And I was telling people when gold was at 2,000 and they were afraid to buy it because they thought it was the peak, I said, no, 2,000 is the new floor. So buying 2,000, 2,100, you're getting in near the bottom. People were afraid it was the top. I kept saying that this is a new day. This is a big bull market. You got to buy this level. And sure enough, we're almost 3,500. We're going a lot higher. Same thing with silver. Silver was 31, 32. I kept telling people, you got to buy it. It's not going to go much below 30 if it even goes below 30. So you're getting in close to the bottom. Now here we are knocking on the door of 40. Don't wait for 50, right? Yes, would it have been better if you bought it a couple of weeks ago? Sure. I tried to get you to buy it a couple of weeks ago. But if you didn't do it then, do it now, right? Why buy 50 when you could buy 40? And the move from 40 to 50, that's still a 20% gain. You buy $40 silver at $50, you got 20%. But 50 isn't going to be the top. It's nowhere near the top. In fact, I think once we get through 50, 50 will be the new 30. 50 is going to be the support for silver. You'll be lucky to be able to buy silver below 50. Right now, it's a double top from 1980 and 2011. That resistance is going to become support, just like $2,000 was the resistance in gold.
In today's news recap, Fidelity says the gold bull run is far from over. Despite already putting in a strong performance so far this year, Ian Sampson, multi-asset portfolio manager at Fidelity International, is confident gold's bull run can hold on over the long term. Having risen 27% in 2024, he noted the asset class is already up 28% over the year to 25 August, making it one of the best performing asset classes in Fidelity's multi-asset portfolios. However, rather than dial back any exposure to the yellow metal, Sampson said a mix of falling interest rates, sticky inflation, and subdued growth should all bolster the prospects for gold going forward. It should lead to a subdued dollar, which is gold's main competitor, as a safe haven and store of value, he said. We have never seen this scale of uncertainty and change around tariff policy, and the effects are yet to dissipate. Gold's status as the ultimate safe haven leaves it well placed for any further surprises. In addition, the unrelenting size of the U.S. budget deficit raises concerns about monetary debasement, which further boosts the long-term case for gold. Multiple countries, including China, India, and Turkey, are structurally increasing their holdings of gold in a bid to diversify exposure away from U.S. dollar, he said. Gold has long been a store of value and a diversifier, without the credit risk associated with paper currency reserves. More broadly, gold supply is very constrained, meaning even a small increase in portfolio holdings could move the dial. For instance, if foreign investors decide to move some of the $57 trillion they currently hold in U.S. assets, gold is a likely beneficiary. For much of the year, this had been through a combination of passive instruments that track the gold price directly and through a selection of gold miner equities. He said the latter has outperformed in the last few months, and we have taken the opportunity to book some profits, but retain exposure to the gold price. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps. And check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trading the gold-silver ratio and increase your ounces. With this easy-to-read book, you'll know everything you need to know to stack efficiently so you don't have to rely on market commentators. Enjoy the episode.
2022. But throw that out, despite the tariffs, the trade deficit is surging. And what drove it there was I think a 6 or 7% spike in imports. Exports went down. Despite these tariffs that are supposed to reduce the trade deficits, they're getting bigger. The budget deficits are getting off the charts bigger. So the twin deficits are increasing. And all of this is bad for the dollar. The dollar's going down, and that means gold prices, silver prices are going up. And I think the fact that you're getting the movement that we're seeing now in these gold mining stocks, they're going up on days that gold is down. And when they sell off in the morning, they rally and they close up. So there are buyers. There are big buyers for these stocks. Why? Because the institutional investors are finally realizing how cheap these stocks are. And they finally are gaining some confidence in the longevity and stability of the gold bull market. Even if gold stays where it is, these gold stocks are cheap. Investors have been afraid that gold was going to crash. And so they stayed away from these stocks. Now I think they're coming to the realization that gold's not going to crash. It's the dollar that's probably going to crash. So they're buying these stocks, but they still haven't accepted the reality that the gold price is going much, much higher. And again, so will the silver price. Once they accept that reality, then they're really going to get aggressive in the buying of these stocks. But one of the kind of negatives of the gold bull market was the failure of the gold mining stocks to confirm the bull market. I've been hearing this for years, that this lack of confirmation shows that the gold market bull is running out of steam, because the thought process was the stock market investor is forward looking. So the stock market investor is not looking at today's price of gold, but at the future price of gold, and using that future price to discount the expected earnings of the gold mining companies. So the fact that the gold stocks were weak meant that investors expected that gold price to go down. And so you had this negative sentiment. Now, what I was saying all along is, well, you know what? I think that's bullish, because it shows that there's no confidence in this bull market, so it's going to keep on running. And it's been doing that the whole time. The gold has been going up. Gold's been going up for 25 years. Gold's done better than the S&P 500. Just buying an ounce of gold and hiding it in your underwear drawer. I think it's about a 9% or so compounded return for 25 years. I mean, it's better than the S&P 500, even if you reinvested your dividends over that same period of time. And gold is just a metal. So the whole time gold's been going up, the gold stock investors have been saying that it's not going to stay up. It's going to come down. It's a bubble. It's all short term. It's because of this or because of that, but it's going to come down. Now, investors are starting to wake up that this rally is real. Now, that doesn't mean it's anywhere near over, because we still have the majority of institutional investors to realize this. We've just got a small group of people realizing that this has happened. If you look at gold and silver and mining equities as a percentage of what typical investors have, I think it's about 0.5% of all the investment capital in the U.S. is allocated to gold, silver, and mining stocks, against a historic average of about 2%. But the reason that the average is so low is because most people have no exposure. Most institutions have no exposure, because I think the people that understand the gold story have a lot more than 2%. They may have 10 or 20%. Look at me, I'm like 60%, right? So there are a lot of people who get it that are way overweighted. So that's the reason it's 0.5%. It's because so many other institutions and individuals have zero weighting. They don't own an ounce of gold or silver. They don't own a share of a gold or silver mining stock. And that means there is a, tidal wave of buying that is going to come into this market. And it doesn't take much to lift it, but just to revert to the mean of 2%, 2% of the assets in the precious metals, physical and mining, would mean a fourfold increase in demand, which is not going to be met by an increase in supply, not even close. So this is just early, right? Eventually, sure, there will be rampant enthusiasm among individual retail investors, but we're not even close to any kind of euphoric blow-off. It's nothing like the enthusiasm that you see in crypto and Bitcoin. And by the way, Bitcoin year to date is only up about 15%. So that's half the gain of silver or of gold, and even less when compared to silver. Yet gold and silver didn't get anywhere near the hype that Bitcoin got. Bitcoin got all the help from the Trump administration, all these new Bitcoin treasury companies buying up Bitcoin. And despite all that buy-in, you only have a 15% gain, which could evaporate very quickly.
What do you think of Schiff's take? Do you agree with him? Are you buying more gold and silver at these prices? Or on the contrary, are you selling like most other retails? Post your honest opinion in the comments section down below and share your gold and silver price predictions with the Stacker community. Now check out this next video right here, because it's the perfect follow-up for you. I'll see you on the other side.